Ladies and gentlemen, welcome back. It is I, your host, Christopher Aaron. I am glad to have you here. It will be December 17th, 2020 by the time you see this. We will be focusing on the price action in both gold and the gold miners in this update. I want to get back to what we typically do in this service here, which is to study the markets in the most clear way possible, which is by actually focusing on the price of the assets that we care about. And just to go back for one moment into the philosophy of this channel compared to many of the other services that cover gold and silver and the US dollar, a lot of these places have interviews with people talking about things that sound very brilliant and very fascinating, and they go on for half an hour or an hour, and they make all these great points, except they don't actually show what's happening in the market itself, which we argue here that is actually the most important thing for us to focus on. Think about it for yourself for one moment. What is more important than the actual price of gold or the gold miners? If you are investing in one or both of these or silver, what is actually more important than the price itself? Isn't that ultimately what we care about? And yes, these ideas of sovereignty and freedom are important. They are reasons why we own the metals, yes. But if someone was going to tell you that gold and silver are going to fall in price for the next 30 years, every year, would you still hold those ideals to be as strong as if you thought the price was going to rise? Come on, be honest with me. All right. So what we're arguing here is that the price matters most, and so why don't we focus on the price? Even though we can understand all of those other things that are happening in the background that contribute to the price, let's actually focus on trends, patterns, things that are happening to the price of these beautiful metals themselves, which they are beautiful, right? That's another aspect to them. They're also indestructible, at least gold is. Never tarnishes, never corrodes, will never be worth zero, a lot more than we can say about certain other asset classes that can and have gone to zero in the past. So all these things are important. Let's get back to the price. We are looking at gold, and we are talking about the price of gold in spot price. The spot price is as close to the actual price for the raw bulk commodity as we can get to. The spot price will be slightly different from the futures price at certain times. Why? Because there's always a price, there's always an additional premium to hold something and have it delivered in the future. You have to pay for storage, you have to pay for shipping, etc., etc. So if you want something in the future, generally there's a slightly higher price to pay than the spot price. Furthermore, if you want something fabricated, this is the bulk commodity. This is the price that we'd be talking about as far as 1,000-ounce or 100-ounce bars, depending on which exchange we're talking about, or 400-ounce bars on the LBMA, for example. But this is the price of the bulk commodity. And of course, if you're going to have it manufactured into a more convenient, a more usable, maybe a more pretty form, there's going to be an additional cost above and beyond that, right? Just like there is a cost to buy a manufactured house, which most of the house is made of what? Wood and cement and bricks. But certainly the cost of the finished house is a lot higher than the cost of the raw materials, right? In just the same way, these Krugerrands and Gold Eagles always have a premium above the bulk commodity. Sometimes the premium is higher, sometimes lower due to supply and demand. You just have to be careful for these people that are always saying that the premium is because of a shortage for the actual bulk commodity. We've not seen that yet. It's a possibility that might happen in the future if a lot of physical demand overwhelms the market. It just hasn't happened yet. So we like to talk about things as realistically here as possible. And we are looking at the spot price over the last 3 days, and I will tell you this is a very important point that we're seeing here for gold. If we can close above 1860 here, especially above 1870 for this week, things are looking good. This was a Federal Reserve meeting today, and it was almost a non-event because they basically didn't say anything different compared to over the last few meetings. It's just we're holding rates at zero. We're going to keep buying bonds. We're going to keep watching inflation, et cetera, et cetera. Of course, we know they speak out of both sides of their mouths. There's always the Fed speak. It always has to be reinterpreted into proper English, and of course into a form where the average person is aware that the Federal Reserve does not ultimately have human beings' best interest at heart in general. The Federal Reserve serves its member institutions primarily, and only secondarily is their concern for the average citizen. So it's important to keep this in mind at all times when we're studying these markets. That said, we could go, incredible books have been written on these subjects, the least of which would be The Creature from Jekyll Island by G. Edward Griffin. Highly, highly recommended if you want to get back into some of the more fundamentals of how gold and the gold system and the gold standard works and how gold broke the tide of the dollar back in 1971. It wasn't really Nixon who did it. Gold, the market, actually overwhelmed Nixon and broke the standard on its own. And if you want to get into the founding of the Federal Reserve and how these member institutions came together in the years leading up to 1913 and the passing of the Aldrich Act, Senator Aldrich, you want to get into some of that and how these institutions came together and decided that not for the first time, not for the second time, but in the third time in the history of the United States, that they would try to usurp the power which was given to the people by Congress, which is to control the currency. And they would take it for themselves, being private member banks, taking control of that for the third time because the first two national banks in the United States failed. Their charters were revoked. Why? Because they printed too much money and they didn't have the gold to back it up. So they came back together after a generation or so in the years leading up to 1913, and they passed the Aldrich Act, which is also known as the Federal Reserve Act, and the rest is history. And now we study the price of gold as related to fiat US dollars, which have no intrinsic value, but they have a confidence value. And we have to admit that the confidence in the US dollar is still the highest of any currency in the world at this point. You don't have to ask me, you just ask China and Japan and Saudi Arabia. Are they happy to hold US dollars? Yeah, they still are. You look at some of the comments in the last video that we produced, we're talking about a potential major decline in the value of the dollar, actually, it's not potential, it's underway. We're seeing that. But still, a lot of the comments are, well, I'd rather hold dollars than euros at this point, or I'd rather hold dollars than, British pounds or Japanese yen. So psychology certainly has not changed. We're not in the end stages of this currency regime. We're perhaps at the very, very beginning of the end, or more likely, actually, we're still somewhere in the later part of the middle stages of this regime. And so there's still a number of years for this flirting with a change in the world reserve currency that has been talked about and whispered about for generations now. Perhaps this is actually the generation that will see it. But we will talk about that at a later point. These are all things that go into my mind, my thoughts, and my heart when I'm thinking about things in the background. But then again, it's like, we could talk about this stuff for hours, right, guys? And it's interesting sometimes. Don't get me wrong. I love this stuff too. But at the end of the day, What matters? Reading the history books? Yes, important, fascinating, nice to have conversation tidbits. But is that going to make us the money in the here and the now and over the next several years? I argue that it's probably not. Because gold and silver can move contrary to the perceived fundamentals for years and years and years. All you have to do is look at the period from 2011 to 2015. Gold lost half of its value, silver lost 2/3 of its value. Or look at the period from 1980 to 2001 or 2000, a 20-year period in which gold lost 70% of its value and silver lost almost 90% of its value. And people think, well, this time is different. That can never happen again. Are we so sure? Do we really have the final answers? Or do we need to actually take a look at what the market is saying? Let's get back to that. Here we are looking for a clue. Now, one of the benefits to us as precious metals investors is that we can refer to multiple sides of this same market. And when one side of the market is not clear, let's say the price action in gold itself is a little bit unclear, which it has been over the last several months, we can look at other equally important aspects of the gold market, and we can derive clues, which then we can deduce what is going to happen with gold itself. This is somewhat unique to the precious metals markets. If you're investing in Amazon stock, you don't necessarily have an underlying commodity that you can compare, between Amazon, the commodity, and Amazon, the producers. But with gold and gold miners, we have two separate sides of this market that we can compare. And furthermore, then we have silver that we can compare and the silver miners. So we almost have a quadrant of four separate aspects of this market that we can compare. So gold has been a little bit unclear, but I want to show you what is not at all unclear. In fact, it is the most clear aspect of this market that we are looking at right now. And this is meant to give you a little bit of motivation right now. If it's been tough for you to hang on here for the last 4 or 5 months since the peak in August, this is meant to provide you a little motivation, but with reasoning behind it. I'm not just here to blow smoke or pixie dust in places where it doesn't usually go, shall we say. We're here to look at what's actually happening in the market, and if there's reason to have some optimism, then let's have it, okay? So we are looking at the Junior Gold Miners ETF. This is the GDXJ, the Junior Gold Miners ETF, which, in my opinion, is actually one of the more useful ETFs to look at. At certain points, it is actually more useful to look at the Junior Gold Miners than the Senior Gold Miners. It depends which one is the most clear. And just for example, the Junior Gold Miners ETF here holds a basket of almost 70 different companies, whereas the Senior Gold Miners, the GDX, is less than that. At my last count, it was in the 50 range. It oscillates a little bit from quarter to quarter as they rebalance it, and certain companies are included or excluded from the indices. But so the junior, and this is really a junior/mid-tier fund, this holds more overall companies. And the other thing is that there's greater exposure in the Junior Gold Miners ETF towards silver than there is in the Senior Gold Miners ETF. You actually have about 25 of the 70 companies in this ETF that are geared towards silver significantly. And so what you're looking at here is really a wider representation of the overall gold and silver mining sector as compared to just the GDX, the Senior Gold Miners. This is a wider representation of the entire sector. And so we have to look at where we are right now. When we go back and we look at what has been forming here, after the peak in 2011, right, the 5-year decline to the low in late 2015, early 2016, And then we look at what has been happening here in the later stages of that decline and extending from 2013, 2014 through just a few months ago. And we look at this as a zone, a resistance zone. This is after a decline for an entire sector that is not going to go to zero, yet lost about 85% of its value. What then started to happen is that the sector began to move sideways. Can you see that? Sideways price movement here, 2013, 2014, 2015, all the way through the mid part of 2020. This is what we refer to as a stage 1 base. You have a stage 4 decline, a stage 1 base, and then a stage 2 advance, which we expect to happen after the stage 1 base is over. And look at the number of times here that the gold miners, the junior gold and silver miners, as we said, attempted to break out of this base formation starting in 2013. 1, 2, 3, 4 times, 5 times, 6 times, 7 times, and you have to look closely here, but they're there, 8 times, 9 times, and 10 times, right? This zone between roughly 44 on the index and 55 on the index. You can see the number of times that buyers could not dislodge the overhang of sellers, and this went on for 7 years. 7 years of sideways price action. Pretty important, wouldn't you say? When something moves sideways for 7 years and it can't go to zero, and then what happens? Something changes. We had, after the panic of the coronavirus, we had a breakout. A clear break of a 7-year resistance zone shown right here in red. The breakout up to roughly 65 on the index has been followed by what? A 4.5-month grinding decline here that has gotten a lot of people frustrated, a lot of people that just thought it was going to go straight higher. Markets tend to not do that. Even on the way lower, there are counter trend rallies, right? Same thing on the way higher. There are counter trend declines. And this decline for the last 4.5 months has represented nothing more than a retest of the stage 1 base. A retest. What is a retest? A retest is when a market has shown a new price behavior. It has broken a former zone and then come back into that zone, and literally the market is saying, hey, you buyers who showed up here on the breakout, show me that you are going to show up again. Prove it to me. The bias in a breakout and a retest is that the retest will hold. And that after those buyers that were present here back in June and July, after they step up again, and I'll tell you what, I'm one of those buyers. I'm buying gold miners in here right now. If you want to learn which exact gold miners we are buying, make sure to spend some time considering our premium research service where we cover every single gold miner that we are buying, as well as selling, and all the research why. You can find that on the homepage. So I am one of the buyers in here on this retest because I align with these technicals. I look at a pattern like this and I say, this is the time to be finalizing my portfolio for what? For the fulfillment of an age-old technical adage. What do we mean by this? What is the adage? It's an old saying. This has been passed down for hundreds of years. You know, this form of technical analysis, guys, goes at least as far back into the 1700s in the rice markets in Asia, specifically in Japan. We're talking at least 300 years that this form of technical analysis has been used. So this is not just me making this stuff up off the top of my head. There are generations of people who have specialized in this sort of thing in analyzing markets. And what I'm doing here is simply applying it to the latest iteration of the most important market in the world, which is the gold market. The technical adage, which has been passed down and passed down, is the bigger the base, the bigger the what? I'll give you a moment to think about it. The bigger the what? The bigger the move. So what is this saying? After a long base like this, you have to think about what's actually been happening in a base like this. You have buying and selling and 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 buying and selling. It's been going on, and maybe even a little bit more buying and selling. And after so much of that, after 7 years, you have to think about all those people. Who are all those people who have sold? Where have all the shares been transferred to? All these shares have been transferred to very strong hands. And so once shares have been deposited in strong hands, after all that buying and selling, there are not that many shares left available for the average person to buy. And so when you get a breakout like this, followed by a retest, and participants step back into the market, the bias, the strong expectation is that there will be a big move to come after this big base. And there are ways that we can calculate at least the initial expected move for a base like this. The initial way is to do a measurement of the amplitude of the entire base, which is 40. We've gone back and we're looking at a slightly new data set here. Premium subscribers will know what I'm talking about. I'm looking at a revised data set. The previous data set I was looking at, this gets a little bit technical, but the previous data set that I was referring to took dividend distributions into account and reverse adjusted the previous peaks based on the dividend distributions, which is attempting to give an overall net return for the fund, and it's accurate in doing that. But what it was not accurate in is showing the absolute price levels that were achieved back in 2010 and 2011. So we're now going back and we're looking at the absolute price levels without dividends included. And we're looking at the amplitude measurement here of being 40, and this amplitude measurement can give us a fairly reliable price target for what should be happening after this retest is over. We add 40 onto the breakout point of 55, and that gives us a target of 95. 95 from where we are here in the 53 region is an 80% move from where we are currently. An 80% move across the average gold miner, mind you. Average gold miner. A lot of gold miners are going to be moving multiples of this 80%. And remember, this is not a long-term target. This is really an intermediate-term target. We're talking over the next several months into 2021. This is the target that we're expecting. 80% move is almost a doubling. That would be pretty nice. Pretty nice if our portfolio doubles here, or almost, within the next 3, 6, 9, 12 months or so into 2021. This is the officially calculated target for a move with an amplitude like this from a big base that is then projected into the future. This doesn't even get into, however, what we will be expecting when the GDXJ, the Junior Gold Miners Fund, and Silver Miners gets back to the previous all-time high, which was up here in the 175 region, which from the present point would be a 230% gain. Over a tripling. Remember, a 100% move is a doubling, a 200% move is a tripling. Over a tripling, just to get back to 2011 peak levels. Think about where gold is right now. It's flirting with that 2011 peak. And then think about whether the big money, if you're trying to hit a couple home runs and trying to change perhaps the potential for your life over the next several years, is it worth allocating some funds to a gold miners ETF. Perhaps it is. Perhaps it is not. It depends on your individual situation. Or perhaps it's worth allocating some funds to the individual gold miners that will move a multiple of that 80 or 230% in our best expectation. Nothing is guaranteed in the world, not what I'm saying to you here, not what any human being is saying to you, but we have very good data to support what we are looking at. And so the point of this video is I wanted to give you guys a little bit of a background as to some of the fundamentals that I believe in, some of the fundamentals that I know deep down inside and that I keep in the background of my mind all the time when I'm producing videos like this, but also the technicals that I am looking at right now that are showing me in a highest probability sense what should be happening not only to the junior gold miners that we looked at, this GDXJ, but the implication of that. Answer me this question. How do you have a junior gold miners and silver miners fund that is going to be moving, let's say, 80% higher over the course of the next 6 to 12 months? How do you have that happen unless there's a significant move setting up for gold and silver themselves? So we're making some deductions here. We're talking about what should be happening to the prices of the metals based on what should be happening to the metals producing companies. There should be significant moves setting up here, and that's why we take the time and we try to look at everything here in these videos and even more in the premium members only service, which I think you should check out if you're serious about investing in this sector and serious about trying to stay up to date with what's happening and serious about trying to change the scope of your life over the next several years. I really think you should check it out. We produce weekly videos like this, but we don't only cover one fund, the GDXJ. We also cover every single week gold, silver, the U.S. stock market, the U.S. dollar, the rest of the commodities sector. Why? Because everything is related. If you don't think so, you're living like an ostrich. You're putting your head in the ground and saying, the only thing I need to focus on is, let's say, the price of silver. That's the only thing I care about. No way. No way. There's absolutely no way you will be a well-informed investor if that's your strategy. You might get it right once or twice, but there's absolutely no way you'll be making a career out of this and doing this, for the next 2 or 3 or 4 or 5 decades, depending on your age, if you're only looking at one small segment of the market. Everything is related. In this service, we also cover the exact gold miners that we are buying and selling here with fully updated research reports. They tend to be 4 to 5 to 6 pages in length. And then we send flash updates right to your inbox at exactly the moment that we're buying these miners so that you know exactly what we're doing here. This is all going into the one service called Precious Metals Intelligence. If you would like to speak to me one-on-one, you're saying, this is a lot of information. There's a lot to digest here. Chris, maybe you have some good points here, but maybe there's some points that you didn't address here. I would just like to talk, get this stuff off my chest and get your take on it. This is why I do individual consultations with individuals such as yourself. There's no situation too big or too small. I'm telling you this. I work with people who are just starting in this sector for the very first time. There's nothing too small. I work with people who have been in this sector for 20 years and that are investing tens of millions of dollars in this sector. And for them, their precious metals holdings are just a small portion of their overall investment strategy. And they want someone who can dial into the precious metals for them and offer them some feedback on that side of things. So know you can reach me on the Consultations tab. I do want to, from the bottom of my heart, thank the people who are supporting this channel on Patreon. Your support means so much to me. I can't even tell you. And make sure you hit the big red subscribe button because that is how you will get notified when the free videos come out. On the topic of the next free video, it will be this time next week, and then I'm taking the following week off for Christmas, in between Christmas and New Year's. And we'll have a few things coming, a couple special announcements next week. I am considering opening up our $1 trial to the premium service sometime in January. But again, you have to think for yourself. How important is it for you to save a couple $100, and then by waiting several weeks, some of these gold and silver miners can move 10% in one day. So you have to think about how important is it to wait to save a little bit on the service versus how much could you miss out on by waiting several weeks to even start to formulate your plan, right? Think about things like that. The most important thing that I want to leave you with this week is that we see good evidence. When we study that GDXJ chart and we really look at the message of the chart, we see good evidence that this sector should still have another powerful move ahead of it over the course of 2021. We can't pick the exact bottom and the exact top perfectly, but you look at that long 7-year base and a breakout and a textbook perfect retest, which is underway right now, what other message do you get? You tell me what you see there. I've studied these patterns over hundreds of markets over the last 15 years, and I'm telling you what I see, but I will never say that I get 100% of things right. No human being will. All we can do here is align with the highest probabilities, and that's what we're trying to do. And we have some good probabilities ahead of us. So thank you for tuning in this week. I will see you in 1 week. Make sure you pay attention to your health, because if we all come out of this multi-millionaires, which I expect that we will, it does us no good if we do not have our health to back us up, right? So there's things that we have to focus on other than just the finances. And some of those things are topics that I plan to get into in the new year. I'll leave it at that for now. Have a blessed week. I will see you this time next week.